Fare impresa in Italia è una corsa ad ostacoli, piena di inefficienza e lentezza, soprattutto se sei una PMI. Ma almeno con la gestione del conto puoi andare di corsa, grazie a Sibyl, un'azienda italiana al 100% che conosce bene le esigenze dei nostri imprenditori. Il conto Sibyl lo apri online senza quella cosa ridicola che devi fare la fila in banca e firmare 4 kg di carta che nel 2025 non si può sentire. E poi hai tutto integrato in un'unica piattaforma. Bonifici, pagamenti F24, gestione carte, flussi di cassa, scadenze, fatturazione e riconciliazione automatica. E quanto sono flessibili? Flessibili? Sibyl? L'avevi capita? Per esempio, vuoi solo il conto e non la fatturazione? Nessun problema. Scopri di più su sibyl.com e fai correre veloce la tua impresa.
Welcome back to The Bull, your personal finance podcast. Over the past year, since last December when Eugene Fama came to visit, I've had the honor of hosting an incredible lineup of finance legends, investors, academics, educators, asset managers, and many more. Each of them has been extraordinary in their own way. But if I keep calling every guest extraordinary, the word itself risks becoming a little less extraordinary over time. That said, today's guest truly is extraordinary. It's hard to read any serious paper on finance and stock markets without coming across research by John Y. Campbell, Harvard finance professor, co-parent alongside Bob Shiller of the famous CAPE ratio, and perhaps the person who has contributed most to our understanding of what drives long-term stock market returns, and therefore how to make sound asset allocations decisions. I sincerely hope that one day he will receive a highly deserved call from Stockholm. While we wait for that moment, I leave you with this remarkable conversation with Professor John Campbell on the predictability of future returns, on how to invest accordingly, and on how to spread sound personal finance practices to make the world a less financially unfair place. Enjoy the episode. Dear Professor Campbell, welcome to my podcast, The Bull.
Well, thank you for having me, Ricardo. Glad to be here.
It's a great pleasure and honor to have you here. Today, we're going to start with very high-level topics, but with an ultimate scope in mind, which is to implement these ideas for the everyday retail investor. You've just finished an important work for the average John Doe to help anyone to invest the right way and to have a healthier relationship with money. So, we're going to try to explain complex topics to make them feasible for the people like us. So, direct question as an icebreaker. Are long-term stock market returns somewhat predictable?
Yes, I believe they are, and this is basically a reflection of the principle that the price matters. So if you're going to buy an asset, you're buying a claim to future cash flows of some kind, whether that's a government bond, a stock, whatever it is. And so the price at which you buy those cash flows will affect your return. And in general, the more expensive the asset, the more you pay up front, the lower the return you should expect to get in the future. So a lot of the work I've done has really explored the analogy between bonds and stocks. So in the world of bonds and fixed income investing, investors are very used to the idea that the price matters, because the cash flows are pre-specified. And if the price goes up, that means the yield goes down, and the yield is what you will earn on a bond if you hold it to maturity. So that's kind of familiar, but people haven't always applied the same thinking to assets with risky cash flows like stocks. But one theme of my research over many years is that stocks are somewhat like bonds in that if you pay more upfront, you're going to get a lower average return over the long run, it's analogous to getting a lower yield on a bond.
Very recently, Antti Ilmanen from AQR made a point that since bonds are clearly influenced by starting yield, and this is widespread for the typical investor, bond investors tend to have a forward-looking approach toward future returns. While on the other side, stock investors tend to extrapolate from past returns. Do you agree with that idea?
I certainly think, yes, I think that's true. And there is a tendency for retail investors in particular to extrapolate. It appears that, more sophisticated institutional investors and sell-side analysts, if you analyze the returns implied by their price targets and their earnings forecasts, you don't get so much of this extrapolation. So I think extrapolation is something that retail investors tend to do, and it occurs in part because so much of what people see about the stock market is price movements. This is what people are being shown. This is what you're invited to focus on. And so it can become natural to extrapolate. There's also the very human bias to basically place a very high weight on what you yourself have experienced. So particularly if you're a younger investor and the last few years have been great for the stock market, that's all you've ever seen, you tend to assume that's the world that you live in. And I will say that even in the bond market, until 2022, we lived through almost 30 years of very good bond returns as yields came down, as inflation came down. Now, obviously, it was a bumpier ride in Italy with the Eurozone crisis, but in the US and many other developed countries, there were 30 great years for bond investors.
Maybe better than stocks return.
Yes, in some cases, and certainly adjusting for risk. So the danger is that investors have concluded, hey, the bond market always does great. But of course, if we've reached a point at which, yields are extremely low, as they were in 2022, very close to zero. I mean, they couldn't keep going lower. It's that extrapolation, that sort of long run extrapolation of the previous decades, that was a bad mistake.
In one of your many articles, I read that you made a point about the fact that the stock riskiness diminishes over time faster than that of bonds, while in theory, they should be following the same rule, 1 divided by the square root of n, with n being the years ahead. That would tell us that stocks are mean reverting. All of this has clearly something to do with stock predictability. Could you please expand on that and possibly explain better what I've just tried to say?
Yes. So, the classic formula that says that risk, standard deviation, grows with the square root of the holding period. That is true in a world in which every period there's a new draw. You're tossing a coin one more time. You either go up, you go down, and every period is a new random draw. And when the world is like that, then risk grows with the horizon in the way we mentioned. Now, in a world in which what goes up must come down, a world of mean reversion, where ups tend to be followed by downs and downs tend to be followed by ups, the mean reversion lowers the risk at long horizons. Now, actually, for a bond that you hold to maturity, that's the extreme case. Let's suppose you've got an inflation index bond, so don't worry about inflation. If you hold the bond to maturity, you know what the price will be when it matures. So actually, there's zero risk if you hold to that horizon. But in the short run, of course, interest rates can move around, the bond price can go up and down. But the risk, rather than growing with the horizon, it actually shrinks to zero if you can hold all the way to maturity. Okay, now that you won't experience that if you're invested in a bond fund, because the bond fund will always be, rotating bonds in and out. So it never matures. But that force of mean reversion is at work in the bond market. And the research I've done says that the same force is at work in the stock market, because periods of rapidly rising stock prices, like the 1990s, for example, tend to be followed by periods of either stagnant or declining stock prices, like the early 2000s. And so it's not quite what goes up must come down, but it's what goes up will with higher probability come down. And even if prices don't come down but just stagnate, you're going to get a lower return because you've got a lower dividend yield. And so there is a tendency for high returns to be followed by low returns, and vice versa. It only shows up clearly over long holding periods of 5 to 10 years. But it does mean that a long-term investor can, shouldn't necessarily use the short-run risk of stock market returns as the measure of risk. This is a point that was made very effectively by Jeremy Siegel in his well-known book, Stocks for the Long Run, which I would say exaggerated the case. He argued that in the US, over periods like 30 years, stocks are actually safer than bonds.
Zero risk.
And he pushes the point too far.
It was 1994.
It was 1994, and the brokerage firms loved the book, and they bought many copies for their clients. But this is an argument why a long-term investor can afford to take more stock market risk than a short-term investor would do.
Yeah, totally. You mentioned earlier your research, and mainly in the 80s and in the 90s, you did a lot of research with Robert Shiller about the different components of stock returns, mainly yields and discount rates. Could you please explain what this framework reveals about the main drivers of return variability? Because I feel it's relevant today with the very high valuations in the stock market and people prone to think, high valuations, a great earnings growth prospect in the future, which is typically not the case.
Well, what Bob Shiller and I did, and, I should preface this by saying that Bob Shiller was my dissertation advisor at Yale and a great inspiration on my career, and it was just a huge privilege to work with him. But what we did was we developed an accounting framework that could be used to break either ratios, valuation ratios, like the dividend to price ratio or dividend yield, or the CAPE ratio. You can break those ratios into components which are attributable to the forecasts of cash flows and the forecasts of returns. So call that the cash flow component and the discount rate component. So the first thing that Bob and I did was we showed some evidence that a lot of the movement in the dividend yield and a lot of the movement in the CAPE ratio is, in fact, attributable to the discount rate piece. It's the equivalent of bond yields going up and down because interest rates change, rather than because you expect any different future payment on the bond. So the point was that the stock market is more like the bond market than you might think. I actually
volatility puzzle.
Right, exactly. So a lot of the volatility is not justified by changing forecasts of future profits, but comes from somewhere else, this discount rate. And then, of course, the question is, what is that discount rate? Maybe we can talk more about that in a minute. But I'll just mention that I extended this decomposition approach to look at returns. So you can say, well, the standard deviation of the stock market return in the US, let's say it's 15 or 18% per year. What's causing that? What's driving that? Is it that sensible revisions in cash flow forecasts move around that much or not? And in fact, the answer is not. About 2/3 of that volatility in returns, I estimate, is driven by discount rates, and only 1/3 comes from cash flows. So put another way, if there were no variation in discount rates, the stock market would be much safer. It would have a standard deviation of, let's say, 6% instead of 18%.
I read an article published in July in the Journal of Finance where they show that discount rates are responsible for a whopping 75% of the variability in valuations. So they were even further with their empirical analysis. But the point is, what are discount rates? Because this is the topic in finance, in my opinion.
Right. So, at some level, for an individual investor who knows their own preferences, it may not matter, right? In other words, the big debate in academia is the discount rate moving around because there's a lot of irrational investors who get carried away, extrapolate, pile into the stock market. They're not thinking, they push prices high. That's the model of noise traders would be the old word, but irrational investing. Bob Schiller, my advisor and co-author, is very associated with that view. My Harvard colleague, Andre Schleifer, is very associated with that view. And that's certainly one important possibility. It's also possible that the discount rate is moving around for other reasons related, for example, to preferences. So I've done work with John Cochrane. One of my well-known papers with John Cochrane shows that if investors have a particular type of preference called habit formation preference, whereby they really want to sustain a standard of living that's related to what they've lived through, and they want to guarantee that first, then people can behave more cautiously as prices fall. The intuition is, if bad times come along, prices fall, people are threatened because their essential standard of living is threatened. For an individual, you might think, oh my goodness, if I lose any more money, I'm going to have to pull my kids out of their school and move to a poorer neighborhood, and my spouse is going to be mad with me, and it's really bad, and I have to lock in the standard of living that we as a family expect, right? That would be a sort of intuitive example of habit formation. So in a world like that, if many investors think that way, then their risk aversion goes up in bad times. People become more cautious in bad times because they feel they can't afford any further losses without jeopardizing their habit, their accustomed standard of living. And what that will do is it'll raise the discount rate in bad times. So low stock prices will be associated with high discount rates. And this will amplify the movements in the market because when bad news comes in, prices fall because of the bad news, but they also fall because now investors are more reluctant to take equity risk. So that's another story about where the time varying discount rate comes from. It's related to points about what an individual should do. If you don't actually have this habit formation motive, but you have the classic preferences that have constant risk aversion, but you live in a world where many other people do have this habit formation, or in a world where many other investors are irrational, you should react by taking more stock market risk when prices are low, because that's when you'll be rewarded for taking the risk that nobody else wants to take.
Yeah. So the two extremes are, on one side, discount rates change because of rational decisions, which is something Eugene Fama would probably agree with. On the other side, discount rates vary because people move between fear and greed. Maybe the truth stands somewhat in the middle, and both have kind of a role in explaining the general market equilibrium.
Yes. Riccardo, the view you just expressed that sort of the markets are very complicated. There are investors with different motives, different degrees of rationality, and prices emerge from the interaction of all those investors. And it's kind of messy and complicated. That's a view that I've come to over the years as I get older and hopefully wiser. The models we write in academia tend to be simple, stripped down models of one of these phenomena, one of these drivers of behavior. And we do that in order to isolate a particular mechanism. So John Cochrane and I wrote a paper where the only thing going on is habit formation. Andre Schleifer will write a paper where the only thing going on is extrapolation of returns. But, the world is more complicated than that. There's probably a mix of these things.
Yeah, it's always curious to me that, for example, if you watch CNBC, sometimes you see headlines like, oh, everyone is selling, which is clearly impossible because you need someone else with a different view of the market who's currently buying for the market to clear. Sometimes people tend to forget that there is a complex equilibrium and different stratification of market dynamics. You said when prices are low, you should be taking more risk and the other way around. Now, with the S&P 500 trading at 23 times forward earnings, and the CAPE ratio, which, by the way, you contributed to popularize with Bob Shiller in the 80s, at 38...
Sorry, Ricardo, may I just interrupt that? So you said 23 times forward earnings, and that's certainly a very meaningful ratio. But the CAPE ratio actually is a backward-looking ratio that doesn't rely on analysts' earnings forecasts. In part because we want something that we can measure, all the way back into the 19th century. But also in part because we're sometimes skeptical of those earnings forecasts. Because analysts, like other investors, can get carried away. They may be, for example, projecting, making very optimistic forecasts of the earnings that AI companies will generate from their investments. And so the CAPE ratio is, if you like, it's a show me the money ratio. It's not about forecast. It's about past earnings. Now, and saying, look, the only thing that's really meaningful, a meaningful guide to future earnings is what earnings have been. However, we smooth over some number of years to avoid business cycle effects because earnings temporarily decline in recessions, but we don't want that to mess up the calculation. So we average. The classic average used these days is a 10-year average. And so CAPE is price divided by a 10-year average of past earnings. Now, that ratio for the S&P 500 right now is about 37. So it's much higher than that 23 that you mentioned. Why? Because analysts are pretty optimistic and earnings have been growing rapidly. So there's a big difference between 10-year average past earnings and the forward earnings that are being projected right now.
Yeah, totally. Anyway, I was just saying that we are quite at a record because only in 1999, maybe beginning in 2000, we had higher levels for both metrics. And now we are in a situation where one should be taking less risk in stocks. And the typical objection is, it's 10 years that people keep telling to underinvest in the US stock market. And we all saw what actually happened. Is this time different? How can we frame a good decision-making process starting from today's valuation without falling into valuation traps?
Great question. Let me bring in one other thing, which I think is actually very important, which is you have to look at the alternative returns that are available. So if you're not going to invest in stocks, where would you put your money? Let's suppose you put your money in a money market fund. Until 2022, for most of the 2010s and through the pandemic period, you were earning very close to a zero nominal rate and often a negative real rate on the alternative asset of cash. And so in that period, even though my view was the expected real returns on stocks were low, the alternative was so bad that the equity premium was somewhat low, but not critically low. Now, what's happened in the last 2-3 years, of course, is that short-term interest rates have come up a lot. So, the long-term real interest rate, that might be a good comparison, the inflation index bond yield, that's come up from zero or negative levels to about between 2.5% and 3% now. So I would say that we now have two things squeezing the equity premium. Stock prices are high, so stock returns should be forecast to be low. And the alternative, which is the real bond yield or the real interest rate, that's come up. So you're left with a modest equity premium. I'm not going to say that the equity premium is negative today, that you should actually forecast that, you will lose money on stocks relative to cash or money market. But certainly the equity premium is very unusually low today, about as low as, certainly the lowest since 1999.
In your opinion, are valuations themselves mean reverting?
Yes, I think valuations, I think they are mean reverting. I think, however, that relative to when I started doing this research in the 1980s, in the time since then, we have seen a very persistent sort of upward shift in valuation ratios, which we've not mean reverted all the way back to the sort of 20th century average. It's as if we see mean reversion, but we also see a component that's persistent and long run, and that stock prices are fluctuating now at a higher level. Now, that still implies lower returns, because remember, prices that get stuck at a high level implies a low income yield, a low dividend yield. So in the 20th century, you could get a dividend yield of 4.5% or even 5%. That was an important piece of your return, was that. And then you would add to that, say, 2.5% capital gain, and that would be your return. Well, now the dividend yield is 1%. So you're getting much less income. So even if prices stay where they are and you don't have any crash, you should expect lower returns because you're getting less income.
Do you think dividend yields should be adjusted for the increase in buybacks that happened over time?
Yes, that's certainly. You either need to add buybacks to dividends, or you need to adjust your growth forecasts for dividends per share. But either way, there's an adjustment that has to be made. So, the difficulty in sort of disentangling dividends from buybacks is one reason why I think using ratios like CAPE or forward earnings yield makes sense, because we don't have to worry. When we use those ratios, we don't have to worry so much about whether buybacks are distorting the measurement.
Yeah, okay. In Finance 101, we have all been taught about Markowitz, the efficient frontier, the CAPM, hold the market portfolio and use leverage or cash to adjust for the risk you're willing to bear, the intertemporal CAPM from Merton, etc. What is left now for today's investors? How can we make a practical use of these great theories to implement one's real portfolio?
So you've cited, several of the giants of modern finance, incredible wisdom from these models. And a lot of the work I've done could be interpreted as simply taking Merton's intertemporal hedging idea and making it operational for investors in the real world. But I want to bring up one thing you didn't mention, which actually I think is really first order for individual investors, which is the integration of the rest of your financial life with your financial portfolio. And let me be specific. If you're a working person, so you're not yet retired,
Human capital.
You have an asset, which is human capital, your earning power. And for young people in particular, that is by far the greatest component of your wealth. Young people have far more human capital than they have financial capital. But even for middle-aged people in their 40s and 50s, actually, 10 or 20 years of remaining earning power is a big asset. And any sensible approach to asset allocation really has to take that into account. Now, a first cut for most people would be to say, look, the labor income is pretty safe. Well, certainly once you're established in your career. And let me leave aside, many of your listeners may be in the financial industry and maybe they get, bonuses dependent on the stock market. But let's leave that aside. If you have a more traditional job with a safe salary and you don't expect to be fired, your labor income is almost like a holding of safe bonds, and really inflation index bonds, because you probably will catch up with inflation in your salary.
Yeah, you get raises. Yeah,
you'll get raises to compensate you for inflation. So it's as if you have a holding of an inflation index bond, which is paying you a real income. Of course, even if you're retired, if you have a big defined benefit pension, and I know many people in Italy do, that's also like a real bond. So you ought to think about it in an integrated way and realize that actually much of your wealth is in safe assets. And that means that the remaining financial piece that you do control and can choose where to invest, you can afford to be much more aggressive than the Merton formula would imply. Right. The Merton formula should apply to the whole portfolio, but to get your overall return, a risky share, to the Merton level, you need to take your financial piece and you need to invest really aggressively.
So you should consider the present value of your future labor earnings.
Exactly. So this is, I think, the most powerful argument, or one of the powerful arguments for these mutual funds called target date funds, which are popular in the US now. I understand they are less used in Europe, but a target date fund is a retirement saving instrument that starts out very aggressive, putting almost all the money in the stock market in the early years. And then as retirement approaches, there's a glide path where you reduce the equity share, not to zero, but to something more like a classic Merton formula. And the idea is that when you're retired, you no longer have this safe earning power, so you can invest a la Merton. But when you're young, you should be correcting for the safety of your labor income by investing aggressively.
Yeah, very interesting.
There's
Merton's framework implies that you should adjust your portfolio over time according to several variables. Your risk aversion is one. I will come back to that in a minute. The other one is more related to expected risk-adjusted returns. Do you think people should adjust their portfolio over time instead of keeping a static, lazy portfolio, or even a target date fund, which is pretty static because they just decrease the equity allocation only considering age and not forward-looking expected returns? I was saying, instead, should the typical retail investor say, hey, the CAPE today is very high, therefore I should be lowering my equity exposure, and the other way around when CAPE is low? Or, for example, should one overweight international stocks instead of US stocks due to lower valuations and so on and so forth? What do you think about dynamic asset allocation?
Yeah, this is a tough question. I think that an investor who can be very calm, deliberate, and gradual in their equity adjustments can do better by scaling back risk when the cape is very high, as for example now. The danger with giving this advice is that it's so easy for investors to overdo it and to pull all their money out of the market when stocks seem high, and then to be very slow to get back in after the market goes down, and to, jerk the portfolio around and end up possibly, even chasing returns, extrapolating, falling prey to all the biases. So, I think, gradual adjustment of returns in response to expected returns is a good thing to do. It's very hard for most individuals to do it right. There are a few financial advisory firms that really try to do this. One, for example, is Elm Wealth, which is the firm that Victor Haghani runs. I think
was our guest. Yeah,
you was your guest. So they have sort of set up a machine to help individual investors do this, and I think that's a good approach. But I'm a little bit in the position of a doctor being asked, well, suppose you think that a glass of wine twice a week is helpful, but that drinking too much is very dangerous. Do you tell your patients, yes, you drink a little wine, or do you say no, abstain because it's just too risky? Too many people abuse it. So that's the challenge I face when you ask me this question.
Yeah, okay. Shifting to the subjective side, which is the denominator in the Merton shares formula, how can we estimate gamma, the risk aversion coefficient, and implement gamma in our asset allocation decisions?
This is a great question. I confront this question in the personal finance course that I teach at Harvard. And I ask the students to take some of the questionnaires that investment firms give their clients, which are a funny mix of questions about, how big a loss can you tolerate before you're going to pay? What's your investment horizon? Are you all kinds of things. Well, then I contrast that with a little thought experiment, which requires a good imagination. But if you can really imagine this situation, I think it will give you the right answer. So imagine that you're in your bedroom, you're asleep at night, and you wake up, and to your horror, there's a demon in the room with red eyes. And the demon says, we're going to play a game. We're going to roll the dice, and with 50% chance, you will lose 10% of your lifetime resources, everything, your salary, your assets, everything that you otherwise would have had is going to be 10% smaller if you lose the game. On the other hand, with 50% chance, everything will be 10% greater. So the demon looks at you and says, roll the dice. And you don't want to do this, so you beg the demon to let you off. And you say, please, don't make me play this game. I will give you some percentage of my wealth. I'll just give it to you now, but just let me off this horrible, risky game. So how much would you offer the demon to get out of the game? That's the question. Now, you have to be, as you can see, very imaginative to do this. But I ask the students to do this, and you get a lot of answers that are in the range 1%, 2%, maybe even 3% of wealth. All right. Now, the formula says that to a good approximation, your risk aversion is twice that number. So if you would give up 1% of your wealth to the demon to get out of this horrific gamble, then you have a risk aversion of 2. If you would give up 3% of your wealth, then you have a risk aversion of 6, and so on.
Great example. Yeah.
So that's a little thought experiment. Now, look, I think for most people, you're going to get some number in the range 2 to 5, somewhere like that. I think most individuals are more risk averse than the log utility function, which is 1. they're more risk averse than that. Some people just a bit more risk averse than that, and some people really quite a lot more risk averse than that. I will also say that I have a paper coming out in the Journal of Finance next year, where my co-authors and I have looked at very, very detailed data from Sweden on retirement savings practices. And we look and see how much dispersion there is in risk aversion and other preference parameters. And we find an average that's more like 7, actually, risk aversion of 7. So the Swedish investors seem quite cautious. So maybe I'll widen the range, 2 to 7. If you think of yourself as conservative on the whole, plug in 7. And if you think of yourself as aggressive, plug in 2 and go from there would be my advice.
Okay, interesting. I use myself a simplified framework saying 1 means indifference to risk and less than 1's risk seeking. So if we are risk averse, let's start with at least 2 and then let's figure it out. I suppose between 2 and 5 works for most of long-term investors.
I would like to quarrel with one thing you said, actually. You said less than 1 risk-seeking. That's really not right. Risk neutrality is 0. Risk aversion of 1 is still risk-averse. However, the investor with a risk aversion of 1, they maximize their log return, their geometrically compounded return, but they're not maximizing their arithmetic average return. They're still penalizing that for risk. They're just penalizing it exactly as much for risk as the geometric average return also does. So I think you ought to think of a log utility investor with risk aversion of 1 as averse to risk, but not very averse to risk. And in fact, they will have the highest average growth rate of wealth. And so if there's heterogeneity in the population, with some people more risk averse, others closer to a risk aversion of 1, the risk aversion of 1 people will end up with most of the wealth. And I do actually think that the very richest investors behave much closer to log utility. And, you know, those of us who are not billionaires very often are more conservative.
Thank you for these clarifications, very insightful. Do you think that tilting a market cap weighted portfolio toward factors could improve the long-term portfolio risk-adjusted return? Because according to this idea of heterogeneity, and excuse me for the pronunciation, it's a very difficult word for me. I was saying, for example, if I invest in value stocks, I am a seller of an insurance somehow to a growth investor, and so on and so forth with the other factors. So in theory, I should be able to exploit different preferences for different investors. Is that right?
Yes. So, you know, I do think that value offers a higher average return. And even though, you know, there are long periods of time where value doesn't work, and it certainly in the US has had a very tough time, really since about 2010. You know, value's been working very well in Europe recently, in the 2020s. So I think you can improve your short-term reward to risk ratio with value investing. What I will say, though, is that growth stocks contribute to the mean reversion of an equity portfolio. So for a long-term investor who values that mean reversion and is in stocks in part because of the mean reversion, it can be appealing to invest in growth stocks to enhance the mean reversion. And what's the idea? Look, growth stocks have cash flows in the distant future. So growth stocks are kind of like long-term bonds. They're the equity equivalent of long-term bonds. Long-term investors should hold long-term assets because they value the mean reversion. And so if you're a long-term investor, that should tilt you towards growth. Whereas if you're more of a short-term investor, value. So that might mean if you're, either older or you have a short investment horizon for whatever reason, for example, because you're trying to earn good returns to buy a house, let's say, then you should go with value. Whereas if you've got a long investment horizon, you should go with growth. There is some evidence that younger individuals tend to be more drawn to growth stocks. We don't know the reason, but there might be some logic there to that.
Maybe because they are typically tech stocks or fancy stocks, while value stocks are more often boring stuff, and they're typically underinvested.
Young people may be more into technology, so there may be just a simple, branding kind of explanation, or familiarity with technology explanation. But what I would say is that maybe inadvertently, but there can be some true investment logic to that.
Yeah, okay. Let's move to your forthcoming work for retail investors, which is called Fixed. The word fixed has two meanings, and it is used intentionally with this ambivalent meaning. Could you please explain why the world of finance is fixed and what we can do to fix it?
Great question, and thank you for mentioning my forthcoming book. This is written with Tarun Ramaduraj, who teaches at Imperial College London. And it's called Fixed: Why Personal Finance is Broken and How to Make It Work for Everyone. This is my first ever book written for a general audience. No math, no equations, no tables of numbers, just plain English and, a few figures to illustrate data. It's about personal finance. It's about much more than just investing. In this conversation, we've been talking a lot about investing, risky investing, stocks, bonds, and so forth. The frame of the book Fixed is everything to do with personal finance, from short-term saving, short-term borrowing, credit cards, buying houses, mortgages, taking out loans to fund education, insurance, all of these things. So why is it called Fixed? The first meaning of fixed is something like the infamous word rigged, meaning a game that's not fair, that is going to benefit savvy people who understand the traps and the tricks and penalize naive people who don't know how to play the game. And we argue that too many personal financial products today are like that. They are hard to shop for, hard to understand, hard to manage, and systematically better educated people, more financially sophisticated people, who I'm sure include, all the listeners to your podcast, will benefit at the expense of people who have less sophistication, less education, and who typically are poorer people with lower income and lower wealth, and that this actually worsens wealth inequality and that we should be concerned about it. The other meaning of fixed is, we can fix this. This financial system is a machine. It is a human design, and with some collective will and clear thinking, it should be possible to improve it. The first part of the book talks about all the problems, and the last part of the book suggests an approach to a solution.
What are the main obstacles to a widespread diffusion of good personal finance at any level?
Well, I would divide the obstacles into two categories, and I'll call them the internal obstacles and the external obstacles. Okay, so the internal obstacles are all the ways in which we as human beings fail to think clearly about finance. Now, again, anyone who's listening to your podcast is way, way above the average and has probably fixed this problem. But, ordinary people have great difficulty doing financial calculations. There's a long list of biases. People struggle with units. They don't understand what, a percent return really means. Just to give one example, it's quite common to chase a large sounding discount on a very cheap item and ignore a small percentage discount on a big expensive item, which is worth far more in dollar terms or euro terms, right? So that's just one example. People don't understand exponential growth. So compound interest, the compounding of returns. This is the thing that financial advisors always talk about, why you need to start retirement saving early so you get compounding. But people really struggle with that.
We think linearly, not exponentially.
Right, we think really not exponentially. We're also very bad at handling probabilities. Bayesian thinking is really not natural to most people. And then, of course, there's also the whole issue of temptation, right? Sort of impulse spending. In the academic literature, the model is called present bias. But present bias just means succumbing to temptation, spending more than you intended to. So there's always reasons why people struggle. And I will also say that because people struggle and they know they struggle, people are reluctant to even think about finance. They don't want to plan. They don't like to shop. People don't shop around because it's so painful. I mean, everybody likes to go and shop for, clothes, sneakers, whatever. But shopping for a mortgage or shopping for a better retirement product, nobody likes to do that. So those are the internal obstacles. But the theme of the book is that then there are also external obstacles created by the financial system, because the mistakes that people make effectively corrupt capitalism. Capitalism is a system that is supposed to use the force of competition to provide the best possible products at the lowest possible price. And when consumers are savvy and know what they want and express their demands in the marketplace, they're price sensitive, they're quality sensitive, then indeed capitalism is a very powerful system for producing those goods and services at a good price. But if people are expressing mistaken demands, then the same force of capitalism will supply those demands. And people will be sold what they think they want rather than what would be good for them. In addition, the reluctance to shop around gives financial firms market power, and they can mark up their products. And there's a group of people who never shop around, who are very inert, who tend to get exploited. And then finally, a big theme of the book is that many financial products require careful management after you've purchased them. Okay, so here's an example. If you get a mortgage in many countries, the UK is a good example, but Italy maybe also, for the first year or so, you'll have a very low rate on your mortgage, a teaser rate. And then after a while, that rate will reset to a much higher rate. So what you need to do is refinance when the teaser rate expires. Savvy people do that. Other people don't know to do that, and they get stuck paying this high standard rate, which they don't need to pay, but they just do. Now, when that occurs, what happens is that there's revenue coming into the mortgage lenders that they can use. They might keep some if they have market power, but to the extent that there's competition, they'll pass it on to borrowers in the form of lower upfront rates. Well, at the end of the day, the savvy people are going to get lower rates because of the mistakes that the less sophisticated people make. There's a cross-subsidy from the naive to the sophisticated, from the poor to the rich. And this is amazingly common. You see it in bank accounts, you see it in credit cards, you see it in mortgages, you see it in insurance policies. And one of the points of the book is to reveal this process, to document it, and to say, we shouldn't be okay with this. This is just not okay. It's contributed to the unpopularity of finance and to a kind of public distrust of formal financial institutions and ultimately of capitalism, which I think is actually very bad for our societies and for our economies.
Yeah. Your solution in the book if I can spoil a little bit, is expressed with the word shove, from nudges to shoves. Could you please expand on that?
Oh no, well, this is not a spoiler. This is an advertisement. This is a summary. Yes. So we use the word shove to contrast with the word nudge. Now, nudge is a famous word because it's the title of a very well-known book by
Thaler and Sunstein.
By Dick Thaler and Cass Sunstein. Yes. And nudge means a light touch intervention that is either a suggestion, we, the regulators, think you should do X, or it's a default which people are assigned to if they don't make an active choice. So the classic example is automatic enrollment in a defined contribution retirement plan. When you join a company, they just sign you up, and maybe they put you into a default fund. It might be a target date fund. And if you don't do anything, that's what will happen. But you have the right to make any change you want. Now, this is appealing because it's inoffensive. I mean, people who don't like it can very easily change and opt out of the default. But the people who are not paying attention or who don't know what to do will just take the default and they'll be grateful and outcomes will be improved. That's the theory anyway. Now, early results on nudges were quite promising. But as we've studied this more, we've come to realize that nudges often have immediate effects that wear off over time. That over time, the people who are nudged through various channels will opt out or alter their behavior, while other people who weren't nudged will catch up over time. And as we've scaled up these things and tried them out in more and more contexts, it looks more and more like rather weak medicine. It's certainly not harmful, but it's not very effective. And in our view, not effective enough. So we say you need to go further. You need to actually shove the financial system. Now, what do we mean by that? To be very concrete, we argue that consumer financial regulators need to specify and quite carefully describe a set of basic plain vanilla financial products. We call this collectively the starter kit for personal finance, the first things people should use, and should require financial firms that are active in each sector of the financial industry to offer these standardized products. They can offer other products, but they must offer these. And importantly, the products should be designed so that they're easy to manage and also very easy to shop for. If I can make another example, think about shopping for a painkiller. You go into the pharmacy and you see you want ibuprofen. Okay, well, you could get a brand name like Advil, or you could get the pharmacy's brand, the generic. They're on the shelf next to each other. The bottles are the same size. The label says compare the active ingredients. The instructions for taking the pills are exactly the same. At most, the pills might differ in color, but otherwise there's one place on the shelf. You look at the shelf and you pick the product that you choose. And we want shopping for these starter kit financial products to be that easy. We think that a system like that will encourage competition, reduce market power, reduce markups. And if the products are made easy to use, you'll also reduce this cross-subsidy problem that I mentioned. Importantly, we're not generally proposing to set the prices. We're not going to tell firms you must price at X price, but we're going to rely on the force of competition to keep prices.
Yeah, market would adjust. Yeah,
right. Now, for a real concrete example from the EU, in Germany, there's a kind of very basic bank account called a Basiskonto, which every bank must offer. Any any resident of the EU can open a basis conto, and the fee structure is specified. It's a plain vanilla bank account, and every bank has to offer it. So that's just one example of what a starter kit financial product might look like. But we in the book have many concrete suggestions, ranging from bank accounts, retirement accounts, insurance policies, mortgages, educational loans, and so forth. Naturally, the details will vary with the country you're in. We recognize that, Italy, for example, is very different from the United States. The whole pension system in Italy is different. The funding of higher education is different. Many things are different. So we're not proposing to impose one world common financial system, but we're trying to give the framework and to encourage deliberate and intelligent system design.
Wow. I would have tons of questions, but I'm afraid we are running out of time. Last one, which is typical when I have guests. If you were to give just one piece of practical advice to a 30-year-old investor, what would it be?
For a 30-year-old investor in the US, I would say, maximize your use of tax-favored retirement accounts, and make sure you contribute the most you can, and then set it and forget it using a target date fund. Probably an aggressive target date fund. Most target date funds, I would say, are too conservative. So find an aggressive one with low fees, get the money in there, and then just forget about it. Don't look at your statements. Don't worry about the market going up and down. Just do that and move on. Now, I'm aware that, in Italy, this may not be such practical advice, but I think basically investing, making a plan to invest in equities, even if you decide to adjust your exposure to the level of prices, as we were discussing earlier, kind of building the habit of equity investing over your lifetime is going to be important. Just because you, the 30-year-old investor, have so much labor income, so much earning power, and you want to complement that with some equity exposure.
Great. Professor Campbell, it was a truly honor to have you here. Thank you so much.
Thank you. Great pleasure.
Bye-bye.
Bye-bye.
And that's all, folks. I hope you enjoyed it and that John Campbell was able to share in just one conversation some key insights that I probably haven't managed to deliver with the same depth in more than 200 episodes. A huge thank you to Professor Campbell for the honor of his time, and of course to all of you for tuning in and continuing to follow me on this journey. As you know, The Bull is no longer just an audio podcast. There are now themed videos on YouTube covering the most important ideas in personal finance. 15 videos are already out and another 10 will be released by mid-October. After that, for those who like video, The Bull will be a video podcast on both Spotify and YouTube. But don't worry, if you'd rather just listen, you'll always be able to do that on your favorite platform. So make sure you subscribe to the YouTube channel to stay up to date with new content and upcoming guests who, just like today, will be truly extraordinary. Always new. That's all for this week. I'll see you next Sunday with a returning friend of the podcast, Nicola Protasoni. He'll walk us through managed futures and explain why diversifying and reducing portfolio volatility can be very helpful for your money. All right here, of course, on The Bull, your personal finance podcast.